Good afternoon, everybody. Welcome to the 12B Green Energy Fund webinar focused for wealth managers, investment managers, and asset advisors. Thank you for joining us this afternoon. Today is a very small, intimate group just of wealth managers. It's not been opened up to the public. That hopefully will be your job going forward. But I'm joined today by Dr. Albertus Marais, who is our tax advisor from Albertus, is the CEO of HAM Tax. Welcome, Albertus. I will hand over to you shortly. I'll just give a little brief introduction about your background. So just a little bit of housekeeping rules today is that unfortunately, Adrian Erasmus, the CEO of Marais Power, unfortunately had a family emergency and had to fly back to East London. So unfortunately, he isn't going to be present today, obviously apologizes. I will try and play the role of EPC if there's any questions, and O&M in case anyone wants any questions in that regard. I'm not technical, but I know a little bit. So hopefully, if there are any technical questions, I can try and assist. But I think what the format of today's meeting is that Albertus and myself will get involved into a chat about 12B and 12BA, as well as the opportunity for investors to invest into the 12B Green Energy Fund Partnership, and then we will open it up for Q&A. And the Q&A, just type into the chat any questions you may have, and then obviously either myself or Albertus will be try our very best to answer your questions. So again, welcome everybody. Welcome Albertus. Let's start with you, Albertus. Just introduce yourself and tell a little bit of background about yourself.
Hi, Jeff. You're placing me on the spot. What shall I say? I can tell you what I'm not. I'm not the CEO of this business. I'm one of the partners of partnership. My partners would be horrified to hear that I'm suddenly been promoted myself to CEO. Look, it's a tax consulting business, and we consult on all matters tax related only. I myself have looked at this incentive in quite a bit of detail, just simply because of you and some of the members in our audience today may be familiar and remember the wonderful days when we still had 12J as an incentive. Now, that of course is gone since the middle of June 2021. But sometimes we have the taxman closes the door but opens a window. And in this case, what we have is not a tax trick, what I want to discuss today with you. What we have is an incentive, something that government wants to encourage the taxpaying public to get involved in to alleviate the energy crisis that we have in this country. And the same was true with 12J. To encourage, that incentive was to encourage entrepreneurial investments, angel investors. This is very much a similar drive. It's an incentive to ask taxpayers to give their money to invest in certain types of assets in order to alleviate a very real and practical non-tax problem. And to encourage taxpayers to do so, government has this carrot that it's waving around as a potential benefit to taxpayers to take up and start investing and help solve problems that we have in South Africa linked to energy.
Okay, well, that's great. So I'll tell you what, before we get into the crux and the nub of the today, let us play a little video to just give us a little bit of ambience and theatre. So Christian, if you don't mind, if you can play the 12B video, and then we can also play the Hooray video on behalf of Adrian. Thanks, Christian. And maybe a little bit of Marais. Okay, thanks, Christian. So that's, just a little bit of an introduction of the 12B Fund, Marais Power. Marais Power is our strategic partner in engineering, procurement and construction, as well as operations and maintenance, which is a post-investment support. Like I said, unfortunately, for those who have joined us afterwards, unfortunately, Audrey Rasmus, the CEO of Marais Power, had a family emergency and cannot join us today. So just to kick off, I mean, Albertus, maybe you want to just tell us a little bit about 12B, when it started, what it's meant for, and then very recently there's a discussion paper on 12BA and how that works for us.
So Jeff, there are a number of allowances in the Income Tax Act. The specific allowance that we're looking at here that was subject to recent change is the one in 12B. Now 12B, what is 12B? It says absolutely nothing. 12B is a section in the Income Tax Act. What that section does, it says, well, if you have certain assets that you invest into, there's an allowance that you get against that asset. It's effectively wear and tear. You can write it off for tax related reasons and purposes. So, for example, if I were to buy a car and I use it for business-related reasons, then I can write that car down over 4 years. That's an example of how a tax allowance works. Buy it for 400,000 Rand, I claim 100,000 Rand in this year and each of the following 3 years then. Now, what 12B does, it doesn't look at vehicles. It looks at certain types of assets, and specifically for purpose of discussion today, looks at assets linked to the generation of electricity. Now, we used to have a rule in section 12B that used to say that if you have assets that are used in generating electricity, if it's less than 1 megawatt of photovoltaic solar energy, then you can write off that investment, the asset that you acquire, those funds that you've used to acquire that assets. You can write off that asset in the first year. If the electricity generating capacity is in excess of 1 megawatts, then the write-off period is over 3 years, 50% in the first year, then 30, then 20. What we have now is a new incentive, and this is this 12BA. Again, it's nothing mystical or anything strange. It's simply a section in the Income Tax Act. What section 12 capital B, capital A says is that we are giving an allowance that is similar to what we had under section 12B, but we're expanding it. We're making it more gratuitous in order to no longer have simply an allowance, but now really to have an incentive, something to encourage. So the allowance that we had under 12B is now expanded in two very important ways. The first is to say that irrespective of the capacity of the assets, in excess of 1 megawatt or less than 1 megawatt, we will allow you to write off everything immediately. So that's the first, and that's quite a significant benefit. The second is we're not only going to allow you to write off the investment for tax purposes, we're going to allow you to write off 125% of the investment. So if I invest 100 Rand, government says, I'm so happy that you've invested 100 Rand in energy creating assets that I'm going to give you 125 Rands worth of a deduction. So that's quite gratuitous, and that's obviously to incentivize. Now, I want to state two things. The first is that it's already quite strange and unusual for capital assets to rank as a deduction. And this is effectively what it is. So to say that I have capital expenditure in acquiring electricity generating assets, but government says you can write it off. Not only does government say you can write it off, government says you can write it off immediately. And at that, I will give you an extra 25%. You can claim 25% in addition over and above that to make this such an attractive incentive and allowance for taxpayers to enter into. So that really is the nub of it, Jeff. I think,
okay, so now,
you go ahead.
Okay, so now, so that gives us so at 12B was around since 2016 on the 1st of March 2023. 12B was into 12BA was introduced, which gives 125%, and that's for a 2-year period. And then we're hoping that still that post February 25 that we still have 12B. There's still a need for 12B. But now, in terms of the 12B Green Energy Fund, we have structured that through an accommodant partnership. Can you give us, just share with, with our advisors today why we use the accommodant partnership structure?
So here I have an opportunity to flaunt my French lessons that I've been taking the past 2-3 years.
Don't show me up here.
Yeah. It's an uncommandit partnership. Now, again, I think it's very important. We have all these phrases, and I get very irritated with my friends in the banking industry because they have all these phrases and words that they throw around, and no one really understands what it is that they mean by it. So let's just understand what it is. Before we get to what an uncommandit partnership is, I want to go back to another word that we've used, and this is a common word, but people don't understand, and it's important to understand it. It's to say that we've created a fund. Now, what the hell do we mean by we've created a fund? What is a fund? A fund can only, depends on what vehicle we've put it in. It's not a mystical creature again. It's either a company, or it's a trust, or it's a combination of those things. It can only be that in South African law. Now, in this case, the fund is the something other. It's a partnership of a number of these entities. So it's a number of legal entities, persons, including natural persons, who club together in a partnership to say, let's pool assets and buy these allowed assets under 12BA. So what we have is a partnership. We don't have an ordinary partnership like we have at AJM that I've alluded to earlier. We have an uncommandit partnership, which is different from a normal partnership in 2 important manners. The first is that it is a so-called anonymous partnership. Now, this is not to hide anything. It's simply to say that I have a main partner that can contract on behalf of the others. I don't need to involve Mr. X and company A and trust B and everyone who's forming part of the partnership. I have one single partner who's the disclosed partner. And I also have this one disclosed main partner that is mandated on behalf of all of the partners to act as the face of the partnership. Of course, in South African law, a partnership is not a person. So I need that construct. So this French term, uncommandit partnership, is really to say that we're forming a partnership of a number of people clubbing together. And I have one partner who is the face of it and contracting on behalf of the partnership, just because there's a number of things that need to be done. But there's another very important distinction, and that is that such a partnership is also one where you have limited partners and unlimited partners. I'm not talking about the sharing in profits, I'm talking about risk. And that's very important because obviously we know in the context of a company, if someone invests in a company, all that they can lose is their investment. They can't be held liable for the obligations and the loans of the company. And that same principle exists in an uncommandit partnership, is that the limited partners, the undisclosed partners who have someone acting on their behalf, they can only ever be held liable for as much as they've contributed. So they're effectively in the same position exactly as a shareholder is vis-a-vis a company. And that is effectively what we have here, is we are dealing with a partnership, a fund, where members of the public are invited to invest as limited partners. They do not need to sign agreements every day. They do not need to be involved in the running of the partnership. For that, there's a limited partner, which Grovest manages. And they're also limited in terms of what it is that can ever happen to their investments. So in that sense, it's very much like a company, but it really, strictly legally speaking, is not a company. And then these partners will all contribute funds, and the partners then collectively, through as a partnership, will acquire all these different assets that qualify for a deduction under Section 12, capital B, capital A. And they will therefore, as a result of being partners in the partnership, be deemed themselves to have these deductions, which they can, of course, set off against taxable income. Now, Jeff, I think what's important here, if I may perhaps preempt a question, is that it is so that very often investors here in these types of funds, like this one that we're discussing today, would be salaried individuals. Quite often individuals that may be retired and earning only capital gains or interest. In other words, they're not involved in a trade, so-called. Why a trade is necessary is that we know that if you want to deduct anything, you need to be engaged in a trade for tax purposes. That's what the Income Tax Act says. What makes this particular product so wonderful from a tax perspective is that if you're a partner in a partnership, the Income Tax Act says that I'm deeming you as a partner to be part of the trade of the partnership by virtue of investing. So if you invest, you're deemed to trade, meaning you are allowed to claim these deductions, and which therefore extend these deductions not only to partnership income, but to other income as well. So if I earn a salary, I can deduct my partnership deduction against that salary income. If I earn passive interest or capital gains, I can deduct that allowance against those incomes in order to reduce my ultimate tax burden for that year of assessment. So this is not a fund simply for corporate investors. This is also something that I think is particularly attractive for investors who do not have an active business, but sit on either passive income or alternatively employment income.
Right. So just to summarize, the in-comedy partnership consists of the general partner who actually runs the day-to-day operations of the partnership, and then you have the limited partners or the undisclosed partners who are the investors in the partnership, who would be investors, but they would be deemed to be carrying on the same business of the partnership, which is really an independent power producer. So by default, they are now becoming independent power producers, and as a result are entitled to the 12B capital A allowance. Okay, so let me ask this question. Is now the limited partner would invest R1 million into the partnership. Now he doesn't automatically get that allowance as we typically received it in the 12J environment. Those funds now need to be invested into solar assets that get deployed and actually generate electricity. Okay, so what is it, firstly, so what would you say is the definition of energy generations? Also, in other words, when you can claim that allowance, or that then the limited partner can claim that 12B allowance? And then what happens is if, let's just say they invest R1 million and the partnership only generates 80% of those assets to generate electricity. What happens in the current year, and is there an opportunity or anything that happens in the year thereafter?
Yes, so you get a deduction to the extent that the contribution that you've made is used to acquire electricity generating assets. So that's the rule. If the partnership says, I'm going to use the cash and I'm keeping 50% of it in the bank and the other 50% I'll buy 12 BA qualifying allowance assets, then you only get the 125% deduction on to the extent that your cash has been used to acquire that electricity generating asset. For the rest, you don't. So that's very important, since it is necessary, therefore, to invest in a partnership or in a fund where you know that the cash will be used to acquire these assets. And that typically will be new investments being launched quite recently. Otherwise, I mean, you already have these assets. And this is another important point, is that the allowance is available only to solar generating assets being brought into use. In other words, they need to start producing electricity, but not from whenever. They need to be brought into use between 1 March 2023 and 28 February 2025. So in that 24-month cycle, the assets need to be brought into use. So I think really we have a very small window of opportunity where there are qualifying assets and funds that will provide for an investment to be received and to be deployed into these assets during those years of assessment.
So just I want to just interrupt you there. Sorry, Albertus. So if you didn't generate in the full year, so only 80% was deployed, in the following year, can the limited partner claim the 20%?
Yeah, so there's a difference here. If the fund deploys 80% and in the next year 20%, then you get the 125% of the 80 in 1 year and 125% of 20 in the next year. But I think your question is perhaps somewhat different, is to say that, let's say, for example, the deduction that I get is 100 Rand, but my salaried income is only 60 Rand. What happens to the 40 Rand? And this is important because that 40 Rand isn't lost. That 40 Rand creates a tax loss, an assessed loss, which is carried forward then into the next year. So to the extent that you cannot use your tax benefit in this year, just because you don't have sufficient taxable income to set this deduction off against, that loss isn't gone. It carries forward to the next year and is capable of being used in that year of assessment.
Okay, great. So I want to focus on the first part of the question, which was how important it is to get the full 100% of the deduction in the year in which the investment was made. Because ideally, investors would like to have, if they're going to invest R1 million, they would like to get 1,250,000 against the taxable income in the year in which they made the investment. And I think that in itself is very, very important. And that goes in what unfortunately, Adrian's not here, but that goes to the execution risk of this type of investment. So which I want, obviously it's important here. We have a whole, all the investment and wealth managers and asset managers. So it's important that they understand the risk, that not what you see is not what you get. Is that it's very, very important that you as an advisor can bring your client into an investment with confidence, knowing that that money will be deployed in the current tax year in order to get the full tax benefit, or 125% of the tax benefit. Of course, if they're best intentions, but if they don't, you can get it next year. But I think you need to make sure that that you really the execution capability of the fund that your clients are investing in, or that you are investing in, is able to deliver energy generating assets in the same year. And that is, what I believe is the 12B Green Energy Fund's secret sauce, is that we have a strategic relationship with Marais Power. Marais Power is an energy procurement and construction company, or we'll call it EPC for technical jargon. It's also the operations and maintenance company. That means that, and we call it O&M, that they continue to keep the lights burning ongoing. So so we have, and I declare that up front that Grovest, which is our holdco, which is which is our umbrella company, has a 45%, or sorry, a 35% stake in Marais Power, which is an EPC that has been operating for the last 4 or 5 years, and putting in a whole lot of solar as well as battery support. A lot of the photos that you saw today have all been supplied and installed by Marais Power, who are experts in large battery energy storage. And we're very confident as a fund that with our alliance, our line of sight, and our management of Marais Power, or ongoing interactions with them, is that we can deploy at least 250 million in the current year. So that means that we could take 250 million and we could make sure that we could deploy it into energy generating assets in the current year. Now, what's important is that yes, you can, we too have the ability as the fund to engage with other EPCs, and we will engage with other EPCs, but not all EPCs are the same. I think it's very, very important to actually understand that every EPC operates differently. They have their own nuances. They have different control rooms. They have different standards. And what gives us a lot of comfort in our fund is that we've been operating and working with Marais Power for the last 4 years. We know their standard. We know what they can do. We know what they can't do, so we can manage expectations. So I think it's just very, very important that execution risk is raised, and we're very comfortable that in the 12B fund we're raising in tranches of 200 million, and that the first 200 million, which is a 50% raise, just over 100 million has been raised to date, and we've started already putting projects into ground. 3 projects have already been approved and started, is that by 28th of February, we would have generated electricity for these particular investments. Okay, so Albertus, just let me ask this story. Now going back, we put in the kit. The kit gets executed timeously. It starts generating electricity. The off-taker then pays the fund for the electricity produced, minus any costs, and then it distributes those profits or distributions to the limited partners. What does it mean in the limited partners' hands?
Yeah, sure. So I think what's important is that this is not only a tax-driven fund. I mean, it's got these tax advantages, which are great, but first and foremost, it's a business that's going to be generating and selling electricity. So that income is generated for the benefit of the partners. It's being sold to the customers of the partnership, and the limited partners share in those amounts to the extent that they are a percentage partner in the partnership. They are entitled to a percentage profit of whatever profits are kicked out as a result of the sale of electricity.
Then that would be taxed in the hands of the limited partner at their rate of tax that they pay. So if there was if someone's paying tax at the marginal rate, they'll pay tax at 45%. If someone was paying tax at 30%, then they would get a 30% benefit for the money that was invested into the fund.
Yes, that is so. But remember that the chances of tax coming about is perhaps somewhat smaller, I would argue, considering that you just had 125% deduction on your capital. So it would, I think, take some time. Let's say there are other income sources as well, but you have a significant tax buffer. That means that this business can kick out profits to a significant extent before you may start to need to pay tax on it, which is quite beneficial. And I want to emphasize here, Jeff, that the ability to invest in this allowance for an individual is perhaps quite limited, if not through this fund. So the fund provides access to this allowance, which other individuals wouldn't have had ordinarily. You'll know that we have two electricity incentives this year that were introduced in the budget. One is this fund. The other one is this rather minor, you get 25% of whatever you put on your roof at home, effectively, limited to 15,000 Rand. So it's a bit of a minor tax incentive, and that I would admit would be available to most individuals, but it's not as sexy an incentive as this one. How would an individual or a business involved in something different than solar energy generation, how would they ever become involved in assets that would give them this very gratuitous allowance or deduction? It's not possible. You need to partner up on your own with Marais Power or whoever else, which makes it very difficult to access. What this fund does is it allows members of the public to access this incentive, which they on their own, for practical reasons, I'd be convinced they would not be able to do. So for that reason, this is very attractive. Is that, yes, you share in the business, but you share in a business that you otherwise on your own would not have had access to.
Yeah, listen, I'm of the same opinion. You're not investing in this fund just because there's a tax incentive. You're investing here for return. And the way that the 12B fund has been structured is that it is a high yield cash on cash return. So whilst one can get gearing into various funds, and by the way, that the 12B Green Energy Fund mandate does allow it to get gearing, it is we first saying that it would be more important to make sure that you deploy the full cash before you start gearing, and then we can worry about the gearing thereafter. But one thing that, so I think it's also important is that the 12B Energy Fund funds the assets and enters into a power purchase agreement with the off-taker for a period of 20 years. Now, 20 years is a long time for, let's say, a retail investor to have an investment, notwithstanding if they could spend be there from year 10 to 20, that's when they make the super profits. But be that as it may, the fund has been structured that at the end of 10 years, that the power purchase agreements or the paper or the future cash flows together with the assets are then sold to, let's say, a fund, an aggregator, another investor, another fund. What would be the tax treatment in year 10, assuming that we sold the future cash flows? As someone invested R1 million, they got the 1,250,000 as a tax benefit, and in year 10 we sell, let's say, the assets as well as the future cash flows for 1.3 million.
So there's a taxable recoupment of your investment. So you pay tax on the amount that you receive back, but not 125%, only on 100%. So let's use the example that I invest R1 million in year 1. I keep that investment and I sell it at the end of 10 years for 1.3 million. I pay tax then on, I've deducted 1 million, so I pay tax on the 1 million that I received back, not the 125%, just 100%, meaning that 25% of this deduction that I get up front is a permanent advantage. The 100% is a temporary advantage that lives for as long as the underlying asset is owned. Once that asset is sold, then that advantage gets reversed, meaning effectively that you've had the taxable value of 1 million Rand, whatever the tax on that would have been for that investor, you have as an interest-free loan from government for the duration of the investment. Because obviously the 1 million Rand will decrease in value in real terms by virtue of the effect of inflation. So that is the advantage, and as far as the 100% is concerned, the 25%, as I said, it's a permanent, you never recoup that you get on year 1 and it's never reversed. On top of the gain that you make, we say we sell not for 1 million that we've invested, we sell for 1.3 million. That 300,000 in addition would be a capital gain. It's taxed at the lesser capital gains tax rates, which are of course reduced compared to the income tax rates that would apply to individuals, companies or trusts.
Okay, great. So I think what's important is that in terms of the 12B Green Energy Fund, the way the business has been structured or the models have been structured, that is in year 10 or the end of year 10, the batteries and the inverters are replaced. And because panels have a lifespan of 25 or 20 years, but the batteries and the inverters only have a lifespan of 10 years. So therefore, in order to sell the future cash flows, it's important that you replace the batteries and inverters in order that the buyer can obviously then generate electricity. Otherwise, they buying a pump. And I think, again, for our wealth managers, our audience, I think it's very, very important to ensure that when your client is investing into a fund, a 12B fund, is that there is a replacement cost made for the battery and in the inverter, bearing in mind that it's in all likelihood that the battery will decrease in price. It's Moore's law. We've seen that all the time with tech equipment, but the exchange rate will definitely, what we've seen will worsen over the next 10-year period. So it's very, very important that that is addressed when actually advising your clients is about the replacement of the equipment in year 10, because if your power purchase agreement is for 20 years, you want to ensure that it has a 20-year production cycle. So I see that we've got, we're getting 15 odd minutes left, and I'm happy to take some questions. I see one question has popped up, but I'd like more people to ask any questions that you may have, because then it'll give us the time to address it. The one question that has been addressed is about insurance. And again, I think it's very, very important that insurance is one of the considerations that that limited partners take into account when investing in fund, is what type of insurance is actually taken out by the general partner or by the manager. So in the case of the 12B Green Energy Fund, is that the equipment is insured for all risks, that's all theft, that's lightning strikes, that's flood, accidental damage or anything of the like. And I can tell you that in the 4 years that we've been there, we've had lightning strikes at some of our sites, and it's very important that you are adequately covered and that you have proper lightning protection installed when you do the CapEx budgets for these particular sites. In addition, because of our experience, we also take out a loss of income or business interruption insurance, that if you get struck by lightning and your equipment takes 3 months to repair the project, that for the 3 months or 4 months that we are out, that you're not generating energy and not generating revenue for the fund, that we are fully insured for the loss of revenue. There's also something called machinery breakdown, which is if not struck by lightning, but because of old age or anything like that, that you would then be insured for machinery breakdown. We only take machinery breakdown when the warranties are complete or expired. Then we would take machinery breakdown insurance. A question is, what happens if the kit gets stolen during load shedding? So we are insured at any time for loss, for theft. Where we are having problems with the insurance company is surge cover, because what happens is when load shedding stops and then it starts again, generally that there is a surge. And the insurance companies, you might have seen it in your houses, I'm sure in your personal insurance, you've got letters from all your insurance companies with the stopping surge cover. is that, but we're fighting very, very hard to maintain some semblance of surge cover in our policies, but that is, something that we're grappling with and working with the insurance companies. That said, we do put in surge suppressors and all the rest of it, that in order that if there is such a thing, that the damage is minimal, if there is such damage. So again, having 4 years of experience, having lightning damage, having understanding multiple load shedding cycles, our engineering team, which is Marais, again, unfortunately, they're not here, would be able to talk to this more technically, but it's something very, very high up on our agenda. And when we contract with Marais Power, it's something that is very much that is managed and brought to account. Okay, I see some other questions here. Let me just go to those questions. I'm just trying to find them. Sure. Right, there we go. So, okay, they say from a tax perspective, given that the nature of the fund is a LP, one Commodore partnership, will the adding and removal of partners throughout the term of the 10 years trigger capital gains tax each time for the other partners? Each time a person leaves or joins a partnership, the old partnership ceases and a new one takes place. Will this not mean that all partners will need to remain until the end of the 10-year period? Albertus, can I ask you to address that, please?
Sure. So the question effectively comes up whether there's a recoupment of your investment by virtue of this common law operation of law that obviously our very well-informed participant knows about. The legal construct is that each and every time a partnership is varied through new partners joining or leaving, there's technically a new partnership coming into being. The question is whether you then have a technical sell and reacquisition of your assets, which then gives rise to a capital gains tax cost or recoupment of your initial investment. The answer is no, from where I'm sitting and my interpretation of the Income Tax Act. SARS has confirmed as much in previous rulings that they've published. You will know, Jeff, that we are in the process of putting together and finalizing a ruling. In fact, we're very well advanced in getting a ruling from SARS on various aspects pertaining to the tax operation of this fund, in order to obviously be conservative on the tax treatment. And SARS has indicated they agree with our stance, that there is no capital gain or recoupment every time there are new partners joining or leaving the partnership. So the short answer is no, it shouldn't give rise to a recoupment or capital gain. And as much is on the verge of being confirmed by SARS in a ruling which they are going to publish specifically for purposes of this fund.
Thanks, Albertus. Then also another question for you. It says here, what happens if you sell your investment in year 5? What happens with the tax incentive?
So the tax incentive gets reversed to a limited extent. To the extent that you realize your investment. Our example earlier, I invest 1 million rand and I get out, let's say, 1.2 million rand. Then I've had a 1.25 million deduction in year 1, 125% of my investment. I end up getting back my money, let's say 1.2 million. 1 million is taxed again, even though I had 1.25 million as a deduction. And the 200 million that I make as a gain over and above what I put in, that is taxed at capital gains tax rates, which are less than income tax rates. Let's keep it simple. Let's forget the capital gains tax. Let's say I invest 1 million and I sell for 1 million. Then I get a 1.25 million rand deduction in year 1, and I pay tax on 1 million rand when I sell in year 5. It's not to say that, oh, but then I only get a 25% deduction. There's also the fact that you get a deduction of 1 million that you carry with you for 5 years, that only gets taxed or reversed after 5 years. In other words, I've had this advantage of not paying tax on 1 million rand for 5 years, which of course has a very tangible benefit linked to it, being that you're effectively receiving an interest-free loan from government in the tax amount on that 1 million that you've invested.
Thanks, Albertus. And we've got a question here. It says, what happens if you have to exit in year 3, or even 13? How will my sales price of my investment be determined? So yes, so that is a 10-year fund. However, the general partner has at his discretion the ability to sell the portfolio earlier if market conditions require. Bearing in mind, you must remember that in the first year, the full portfolio, the full amount of the funds raised will have been invested into energy generating assets. So what we'll be doing is that the fund will be receiving contractual cash flows on a monthly basis that will escalate at CPI plus 1.5, 1 to 2%, average 1.5. So that in itself is very, very good for the off-taker, because then he's not subject to the NERSA increases, which in this year is 18%, next year 12.3%. And I'm sure that in my lifetime that I'm not going to see single-digit increases from NERSA going forward. So the off-taker who actually enters into a power purchase agreement with the fund will be able to, let's say, lock in the escalations going forward. So if you had to leave, okay, there is an option in terms of the partnership agreement that you can exit early. It's subject to obviously the cash flow constraints of the partnership, but because the partnership is generating lots and lots of cash on a monthly basis, the cash constraint shouldn't be a problem. And depending on when you exit, if you exit in the early stages, if you exit in year 3, you will be somewhere between 10 and 12% discount. And if you exit in year 8, will be closer, somewhere between 0 and 5% discount. How it gets calculated would be the future cash flow, the present value of the future cash flows. It would be determined, and then from that there will be a discount applied to the value of the future cash flows of the investment. So Ian, I hope that helps you. What is the fund's philosophy about gearing? So as I said earlier, the fund's mandate has the ability to gear. It doesn't say that it can't gear, but the GP's philosophy at this point in time is to deploy the full 200 million into energy operating assets in the current year, and to utilize those funds to rather repay, or the profits to repay back to investors. So there's a high cash on cash yield starting at 10% and ending in year 9 at 19% cash on the gross value. That said, that is nothing stopping the general partner, their market conditions prevailing, because interest rates at the moment are extremely high. The house view is that interest rates will increase again, and therefore it might not be the right time to start gearing. But in year 2, we may want to gear the portfolio and return the capital back to investors. But that will be in the future. But I think the house view is that interest rate, we don't want to take interest rate risk. We'd rather return high cash yields to the investor. So I hope that deals with that particular
I just, if I may intervene, Jeff, just to briefly say that, of course, nothing prohibits the investor from gearing. So if you say, look, this sounds like an extremely attractive product, and look, it's only available for the next year and a half. It's only till 28 February 2025. Nothing prevents the investor from gearing, from going to the bank and borrowing as much as they would ever want to, and to use that geared funds or the debt funding to invest in the partnership.
Yeah, thank you, Albert. I think that's important. So you can deduct any gearing costs for investment into the fund against your taxable income or the distributions made by the partnership. Question here by Michael. Is there a limitation on the allowance a company can claim in one period? The short answer is no. Not like 12J, which they limited to 2.5 million for individuals and trusts and 5 million for companies. Here, there's no limit, and we have investors investing large amounts of money, both through companies and individual purposes. Is the 12B Green End Fund surely a solar play? Yes, it is a solar play. It's in why. It's something that we understand. No, we know that the equipment works. We know the sun shines, and our risk is counterparty risk. And if we can manage counterparty risk, we're very happy. On that basis, we say that all projects have to be approved by an investment committee, which we have, which is made up of Malcolm Siegel, Derek Finlinson, and Marais Chetty. Malcolm and Marais have a long-standing relationship with Grovest. Derek Finlinson is a lifetime standard banker who is our independent, and he sits on the investment committee and he puts us through the grill. I'm trying to run through these things very, very quickly. What are the related party charges transaction within the model? Who are these related parties, and are these charges market related, and how can the partners determine they're market related and the related parties do not extract some additional profits from the partnership? So yes, so we are targeting between 15 and 16% IRR after tax at the project level. So no investment will be approved by the investment committee unless we meet those targets. We've disclosed that Grovest does have an interest in Marais Power, and it helps us because we have sight of their margins and that we can actually put pressure on them in order to achieve our required IRRs at the project level. Our fees, we charge a 1% setup fee, we charge a 2% management fee on the capital invested, and then we get a 20% on the return of risk capital. Risk capital is determined at the tax benefit plus 110%. You can again say that everyone can say how high, if it's high or low, but if you had to look at what's out there in the industry, you'll see that the setup costs and management fees are a lot higher than what we are currently charging. And again, it's not. I have to again express the caution about execution risk, and quality of execution is very important, that these projects need to live for 20 years. So if you use an EPC that you do not have a relationship with, and that they put the project in and then and they disappear because the pricing might be cheaper, you have a 20-year problem on your hands. It's something that we're very, very aware of. Biomass energy is a captive power plant, so qualifies for SARS-approved allowance. It's not going to be added into our string because we're only focusing on solar, as I said. If it says anonymous, is if the fund gears to deploy capital in year 2 for gearing, then that provides a further deduction for partners. That is correct, but what you got to do is that you obviously have to service the debt, and it is something we're aware of. It's something it's in our arsenal. It is something that we will be able to consider, but we will look at market conditions as and when that need applies. But we are forecasting 18% IRR without any gearing in the fund. Okay, as I mentioned, a discount being applied to the sale of the cash flows. How sensitive are returns to the discount? So I can tell you that there's a Ghost podcast where they put us through to actually discuss and work out what the sensitivity would be. So a 1% difference in the discount rate would only be about 0.45% in terms of the IRR. So it's not very sensitive. That said, in our 4 years, we have sold 2 portfolios of 200 million rand each. Approximately one was sold for 12.25%, the other one 12.75%. We have modeled in the sale of our portfolio in year 10 at 13.5%, which, based on the information that we have today, is pretty conservative. So, guys, they're putting me under pressure. I understand that there's a final poll that I need to, if we can put it on. Christian, can you put that poll on, and then I'll try to answer some more questions along the way. So it says, do you want our team to contact you regarding the distribution of 12B Green Energy Fund opportunity, i.e. you guys are in the business, you have clients, something that we very passionate about, this particular product. In fact, I've been in alternative investments for the last 10 years in a formal and professional manner. I can tell you that in all my years, I've never seen the amount of interest that we've actually got in terms of this product that we put to market. We consider it a medium to low risk product because there is contractual cash flows. There is no concentration risk. It's made up of a portfolio of a number of projects, each project somewhere between 5, 8 or 10 million rand. So you are getting a lot of different products. Also in terms, if the credit risk does not work out, 80% of the underlying asset is made up of panels, batteries, and inverters, which we can uplift and redeploy. It's obviously not prize A, but that is certainly a risk mitigation. So guys, if you can fill out that poll, would appreciate. Okay, can I close the poll and then go back to any questions? Okay, I think we've covered all the, I think maybe we've covered all the questions. Oh no, we haven't. How soon, once we sign the forms, this is the most important question. Thank you, Mina. Once we sign the forms, how soon do we make the capital investment? As soon as you make the forms, you provide us with your FICA, and where you sign the deed of adherence for the partnership, you make a payment at the same time, and you become a partner in the 12B Energy Fund. As soon as you join the partnership, you obviously become the partner, and what happens is our first distribution of profits will be in September of this year. So the close-off will be the end of August, and the distribution will be made in September. So all those who are entering into the partnership earlier will obviously be able to share in those proceeds. Guys, I think we over time, but I really thank you for your attendance. I think we've addressed all the questions. There's been some interesting technical questions. I'd like to, thank you for your attendance. Obviously, if there's certain, or you have other questions and you want us to send you the marketing collateral, you want to have a one-on-one meeting, we can either do that on Zoom or any of the other platforms, or we can meet personally. We thank you. Obviously, there is an intermediary fee that is payable to all, let's say, advisors, wealth managers, who actually support and introduce our product to their clients, and happy to take that offline with anybody who's interested. I also want to say thank you, Albertus, for your time, your knowledge, your wisdom, and for putting up with me.
Thank you, Jeff, for having me. It's been a fantastic session once again. Thank you.
All right, guys, and thanks again for joining us. Cheers now.